everybody to DeRosa Insiders Live. I am your temporary host for today. I am Jacob Sandoval, Head of Investor Relations here at the DeRosa Group, stepping in for Matt Faircloth, and I am joined by my friend, my partner in crime, the brains of the DeRosa Group. We have Hait Patel. Let's start with the hotel space, Hait. Why now do we feel DeRosa should be getting into the hotel space? What is attractive about that asset class? And just for the people that don't have as much background in hotels, why don't you give us just a primer on the hotel space?
Yeah, first and foremost, diversification, right, into a new asset class in itself. Secondly, hotels are fairly comparable to multifamily, especially the strategy DeRosa has been using of value add. You can achieve that in a hospitality space as well. Particularly, you can buy, let's say, a property built in the 1990s, early 2000s, and then right now it's due for a renovation. We can go ahead and do the renovation, and then we will see the increase on the flip side of the revenue and stabilizing the asset. But if you're following the same strategy that we did on all of our other assets, where we buy underappreciated assets, we put in a lot of capex, and then we see the value add on the flip side. So we're particularly targeting assets such as those in Midwest and out in Carolinas and Virginia. As far as hospitality in itself, there's multiple classes within hospitality, particularly one's limited service and one is going to be full scale or full service. So limited service hotels are going to be your Hampton Inns, Fairfields, Home Twos. Within limited service, you have extended stay, which is the Home Two property, or Town Place or Residence Inn by Marriott. That's where you have a room with a kitchenette, dishwasher range. Depending on the scale, if it's an economy segment kitchenette, extended stay Americas, you're only going to get a cooked at the probably some have dishwashers, some don't. So it just depends on the class of the hotel. So for DeRosa particularly, we are targeting upper mid-scale properties within our regions of upper Midwest and out in Carolinas and Virginia. So that's our current buy box. And within our buy box, we're particularly looking at assets at least bare minimum 70 rooms and maximum, I want to say about 150 rooms. So it's a very tight buy box, but there's specific reasons behind it as far as from operations perspective as to why we picked that buy box. If you have a 70 unit property, it's easier to run. You're going to have 24 hours of front desk payroll you have to maintain. You're going to have to hit a minimum of 60 to 65% occupancy. So anything below 70 units in current environment just doesn't make sense for us because the deal will be too small. Hence why we're looking at 70 units on that end. And then 100 from the bigger side, just because from a same operationally the property, and then when it comes to renovating the property and everything, it's a lot more manageable than trying to do a renovation on a 300 unit box and having to put those rooms aside and everything like that. Having to renovate one floor at a time is very hectic when you have 100 rooms and busy days.
Absolutely. Hey, I want to ask you a question on some of the key differences between multifamily and hotels, right? I know one of the differences is in terms of the returns and the valuations. The cap rates are very different from a multifamily perspective with hotels, right? I've heard, and you validate if this is true or not, you shouldn't, as a LP that's investing in potentially a hotel deal, the expectations around the equity multiple, the equity growth, the appreciation should not be the same necessarily as the equity multiple, the appreciation on the multifamily side. Hotels should be viewed more on the higher cash flow side than a multifamily investment. But correct me if I'm wrong, Hait. Talk about the return profile of a hotel deal, maybe the differences in the cap rates and the risk-adjusted return perspective when we're talking about the two different asset classes.
Yeah, so let's start with some examples of what cash on cash might look like once a property is stabilized, right?
Yeah.
If you're talking about a bigger property where we are taking on a CMBS loan, which will be a non-recourse loan, similar to multifamily, we do have to put almost 35% to 40% down payment. But even after that, we are going to be looking at cash on cash for investors from anywhere. It can be varied from 10% to 12%, if not higher. At the same time, a multifamily property of that manner is going to be anywhere from 6 to 8%. So there is an upside, but it's also because there's a lot more risk to the asset in itself. On a hotel, we're collecting revenue on a daily basis. On a multifamily, we're collecting revenue on a monthly basis. The cap rate is also adjusted because of that. Most properties right now in the multifamily, Class B, B plus in the Carolinas that we are looking at are trading around 5.25, 5.5 in that range. So a similar hotel deal is going to be around 7 to 8 cap in that range. If it's a stabilized asset that doesn't need to have value add to it or anything like that, it'll be around that 7 to 8% cap rate. All in, you're probably looking at about 7% with fees and closing costs and everything in that manner. So there is a delta of about 2 cap rate, which is pretty significant at the end of the day.
Yeah.
But the investor returns and the investor expectations and hospitality should be higher compared to multifamily because we're taking on not a lot more risk, but it's just a riskier asset compared to multifamily.
Yeah, absolutely. So just to repeat everything that Hait is saying, there's going to be a very significant difference in terms of the cash on cash return for a hotel deal versus a multifamily deal. In the multifamily world, you're probably used to seeing kind of 6% to 8% cash on cash return. For a hotel deal, you might be talking about double digit 12, 10 to 11 to 12%. So almost close to double in terms of the expectation on cash. The trade-off for that, for example, is going to be obviously the risk adjusted returns. You are stepping into a lot more risk, and the cap rate is reflective of that. I think a lot of people talk about the cap rate as the unlevered return. Another way to think about cap rate is just the amount of risk that you're taking on for that asset. The higher the cap rate, the higher the risk should be. And so when we're talking about a stabilized multifamily asset in the 5 to 5.5% kind of cap rate range versus a hotel deal that's going to be in the 7% to 8% cap rate range, yes, a higher unlevered return, but it is reflective of the risk, which the hotel space is a riskier asset class than the multifamily space. So as an investor, you should be thinking about, why am I investing in this deal? What are the risk adjusted returns? Do I want to wait a little bit more heavily for this investment in cash flow than potentially appreciation? And am I okay with that? These are all important questions that you should be asking yourself as an investor when you're evaluating, hey, what is this hotel deal versus this apartment building deal? You want to think about building and architecting your portfolio in the manner that is most aligned to your goals. Hey, what else about the hotel space that you can share with us for those that aren't very familiar? Are there any particular gotchas or surprises or things to look out for, especially as an operator that's trying to transition from multifamily to hotels, that might not be that straightforward? Is it on the management side? I know revenue management and pricing is such a big component of success, like being successful in the hotel space, whereas in the multifamily space, that the availability and the pricing for an apartment building is very tight in comparison to how well you can operate a hotel, and the pricing is very dynamic, very variable. So maybe we talk a little bit about that on the hotel side.
Yeah, a couple things on the lookout. First and foremost is which brand you're affiliated with. If you're in a, let's say, tourism market where you don't really need a brand to support your revenue, you're going to be well off. But for us, we're targeting all upper mid-scale brands, which are going to be Hampton, Marriott, IHG products. We're also looking at some, let's say, very limited Wyndham and Choice properties. In hotels, first and foremost, you're going to be paying a franchise fee. You'll be negotiating that when you sign a contract, whether it's a new development or you're buying an existing product. What happens is, let's say if the property is, you're buying an older property built in the 1980s, you're likely not going to have a lot of term remaining on their franchise. So for example, Hilton and Marriott are going to be very hands-on. And in terms of, let's say if you had they only allow Hampton in, for example, for most cases, you're looking at maybe a 40 to 45 year maximum on a property. And that is on the very, very high end. They might kick out that property within 30 years. So when you're looking at a new acquisition, you have to be very aware of how long your franchise flag is going to be there. So if you're buying a property that only has a 10-year franchise flag, what does our exit strategy look like down year 10? At that point, do we convert the property? If so, what is going to be the valuation at that point? Because a Hampton Inn has a lot better cap rate at sale than the other properties are going to have. So if you're going to be converting an upper mid-scale product into an economy segment at the end of your tenure, what is going to be that return, and is it still justifiable overall from an IRR perspective? So that's something to always be aware of.
This is interesting, Hait. So when you get to the end of your franchise term, is it possible to renew that term, or is it difficult to do that? Okay.
You can extend it as long as the building and the market support it. So if the building is older than 35 to 40 years, it's going to be very tough unless you're in like the land value is worth a lot and you're in like, let's say, middle of Disneyland or something like that. Then it's very easy because of the location in itself. But you're in a tertiary market where your product is, let's say, 35 to 40 years old, then you're likely not going to be able to keep it as upper mid-scale flag. You'll have to downgrade it to maybe an economy flag. Currently, Hampton and Marriott both are economy.
So understood. So basically, it's really up to the brand itself whether they want to extend the agreement with you in terms of the franchise. And it really depends on whether or not that product maintains or fits within their definitions of what that kind of mid-scale luxury would look like. And if they deem that maybe the building is too old or there's not enough demand in this market, you might need to downgrade to a different brand in their portfolio if they have one, in terms of what would be available. Okay, so this is very interesting. Another question I had was, I'm seeing a lot of things out there on like boutique hotels, right? And these are obviously non-branded hotels. In your view, what is from a strategic perspective, obviously when you go with the brand, the big name brands, like you're borrowing that brand and potentially making sure that you have that demand and also the valuation that's tied to that brand. But what are your thoughts on boutique hotels, and why is this not something that DeRosa is necessarily interested in versus like these bigger name brands?
Yeah, no, boutique hotels are still pursuable. It's just that when you go with these bigger brands, you're almost 30 to 50% of your revenue is going to come from the brand in itself, whether it's the loyalty members associated with Marriott, Hilton, IAG, or any other Choice Wyndham products. So that's the boost that you do get from day one instead of a boutique brand where you might have to ramp up for, let's say, at least 1.5 to 2 years of ramp up, or you're trying to get to the market, trying to get your product up. The other thing with boutique brands is, yeah, you could do a soft branding with a bigger brand like Marriott or Choice or anything. There's different ways and manners where you can do a soft branding of some sort or be associated with the brand, but not particularly have to follow all the rules of the brand. So there are some soft brands that we could potentially look at from a development perspective. But right now, since we're just trying to get a portfolio started, our objective is to just get properties that are going to be easy to maintain, and where we come in and do the value add and do the PIP, which is property improvement plan, which is what the brand issues to us as part of the purchase process. So if I'm buying a new property, the Wyndham brand is going to come down and tell us, okay, this is what you need to do in each room. This is what the lobby needs to look like. This is what the exterior needs to look like. And you probably have 1 year to 3 years on each line item to complete those tasks, basically. For us right now and where we are in the cycle, our buy box is very particular. Once in the future, we might look at boutique brands in markets that are more tourism based, where a boutique brand is more sufficient, because the profit margins on boutique brands are going to be more applicable, but they're getting the revenue to, it's like having an Airbnb in a really nice market where it's just going to fill up because of the location, compared to having Airbnb in a primary market where you're competing against 100 other Airbnbs and trying to stay on top of the game, basically.
No, that's super insightful. Hey, so the other thing that I know is very different with hotels, obviously, is like the revenue kind of management portion
Yeah.
of that and how important that is in the hotel space. So maybe talk a little bit about that and how we as DeRosa and anybody that's looking to get into the hotel space has to think about that a lot differently than obviously just filling the apartment building with tenants, getting the best rent we can for that unit. But it's a lot more nuanced in the hotel space, right?
Yep. Yeah, the principles are still the same. In the hospitality space, it's called a RevPAR, which is going to be your daily occupancy times your daily average rate. If you have 100% or $100 rate and your 50% occupancy, your RevPAR is $50, right? So our goal is to maximize the revenue per room available. So it's not just trying to fill up all the 100 room. If you have a 100 room property, the goal is not to just fill up 100 rooms at lower end rates and trying to maximize that. The goal might be to fill up the room or fill up the hotel at 70% occupancy, while also trying to maximize the rate on the other side. Because however extra dollars you get on the rate is going to go right to your bottom line. The amount of cleaning and the amount of front desk and everything is going to stay the same. Your property tax and everything is going to stay the same. The ideal goal in revenue management side is to maximizing your RevPAR. There's multiple ways. There's a lot of strategies involved in doing that, whether it's promoting your property more on third-party websites such as Booking.com, Expedia, whether it's having sales, particularly at your property, where you're offering more points when a guest books at the hotel. Usually, if it's a 1.1 match, you can offer 1.5 times points when your guest is booking at your property. You can create different rate codes, maybe having a rate code for like people that stay for more than 5 days. They'll get a discount of, let's say, 10. So revenue management is very hands-on. There's usually meetings I would say at least one weekly meetings are there, but there's an email exchange is happening daily in terms of future demand, especially on busy days. We also have days that we call blackout days, where we completely shut off the property. Only reservations that can be booked are usually by a phone call. So there's big events, especially like in Minneapolis, we had Super Bowl. Majority of the properties here blackout. You had to call into the property. You had to pay for the property on day one. It's non-refundable. Events like big events such as those are definitely a different revenue stream, because you could make like a whole month's of revenue within 4 or 5 days. So yeah, revenue management is very hands-on, and along with the revenue comes sales management. So we usually on a bigger property such as a 90 or 100 unit box, you're going to have a sales team as well that is very involved. So they're going to be the ones going out to all the local businesses and trying to get revenue from them, all the local corporate clientele. Along with that, they're also going to be in charge of getting revenue for events such as weddings, sports teams, and any other revenue drivers that might be in your market. Sales and revenue go hand in the hospitality industry, but if you have a really good management company, they'll be able to take care of both of those aspects internally. If not, the brand does provide revenue management services where Marriott, Wyndham, Choice, IG, and Hilton all have their own management supports. So you can sign up for a revenue management program through the brand officially as well if you wanted to.
Okay, cool. Thanks for that, Haith. I love learning about the hotel space and very excited that DeRosa is looking to acquire in this space. I'm very exciting for us as DeRosa and for our investors as well.
Mhm.
Any closing thoughts on kind of the hotel space? Any takeaways for our listeners here today before we switch gears and go into the kind of back into the multifamily space and specifically looking at the underwriting tool?
Yeah, no, hospitality is going to be not the most similar to multifamily. It is going to be quite similar to multifamily, where the principles of the investment, the buy box, the location are still very important. We are looking at buying in either downtowns or right off the exit. So our buy box and the reasoning behind it is very thought out. That's why we haven't purchased a property because of that reason. And then we had a couple of properties where the licensing was an issue, where it was expiring in 10 years and the risk at the end of year 10 was too high for the return. So we passed on those deals as well. Yeah, we are actively looking in the market and we'll definitely have something in the pipeline in the near future here.
Yeah, hey, we have a question from someone in the chat here, Chad McKibben. Is it possible to convert a hotel to an apartment complex?
It is, yes. There's a lot of these assets for sale, like older built 1980s and 1990s that are being converted into apartment complex. There are also extended stay properties that are being converted into apartment complexes as well, that weren't necessarily producing revenue as an extended stay property, and those are being converted into mostly studios. Some of the bigger properties that were like 150 to 2 unit boxes are being converted more into 1 bedroom, 2 bedroom and studios, just because they have a bigger footprint. You will, if you have a 200 unit, you'll probably go down to a hotel as a 100 unit will probably go down to at least 100 unit multifamily project in the end of the day. However, you can take over some of the unused spaces such as the meeting room and convert that into maybe something more social. So there are, but yeah, to answer your question simply, yes, there are developers that are specifically in the conversion game where they're taking old hotels into apartment complexes.
Yeah, thanks for that question, Chad. I do feel it's probably a little bit more nuanced because you don't see too much of it, or maybe I'm not like too aware of it, but I would imagine that it's very similar to, if I can equate it to the long-term rentals versus short-term rentals, a lot of what people say in kind of the Airbnb space, and this is a little bit dated, they're like, hey, you should buy an Airbnb that also works as a long-term rental. I find that kind of assessment to be very flawed because most of the time, a good Airbnb would not work as a long-term rental. And there's a lot of reasons for that, right? You have to buy these bigger properties that are bigger. You have to amenitize them. The cost is going to be a lot higher. So there's just no way it would work as a long-term rental. I imagine that is a little bit similar to the hotel space. Maybe not as much, but a lot of hotels potentially because of the cost or maybe because of the way that they're set up or because of the location, they wouldn't really work as multifamily investments for a variety of different factors. So I imagine that's why we don't see it that much. But hey, what are your kind of thoughts on that?
Yeah, you just pointed it out. The square footage of a hotel room is going to be 300, maybe 400 square foot. Multifamily studios are anywhere from a very efficient studio can be 400 square foot, but realistically 500, 550 is where we're seeing most studios to be. So that is the biggest challenge. Along with that, the zoning challenge of hospitality to a multifamily is also going to be the biggest hurdle in this conversion play.
Yeah,
so you're going to be very active in that community. The city have to make sure that you can get basically the rezoning done.
Which is crazy, right? Because we have and depending on which source you're citing here, we have anywhere from a 3 to 7 million housing unit shortage. So the fact that potentially you can convert a hotel to residential housing, you would think that would be viewed as favorable given the housing shortage, but it's not the case. It's not the case. Anyway, that's an aside.
Because hotels are located in very different commercial spaces than multifamilies are. Like the buildings that we have that are spread across like acres upon acres are a mix of residential commercial, while hotels are going to be in the very commercial base of exit or right in the downtown corridor next to all the other revenue generating. That's the biggest issue. It's just a location.
Totally. Thank you for that question, Chad. And thank you, Hait, for taking us to school on the hotel space.